In chapter number 10, we will discuss how financial institutions manage the investment function, which is investment in securities. To put things in perspective, in chapter number 8, we talked about how do financial institutions hedge securities in the event market interest rates were to change. In this chapter, we will discuss how do they manage investment function, particularly related to minimizing the income tax liability. There are certain pages that we're going to exclude, and I will point those out as we go along. We will first talk about the different functions and the different nature of investment products that they invest in. We will discuss the expected returns, which we, by the way, talked about in chapter 7, when we discussed market rates. Income tax and the interest rate risk. And then we will go through what is known as the income tax liability by going through an example. Depository institutions, specifically banks, they do invest significantly in securities portfolio. Keep in mind, please, that securities that they invest in are typically government bonds. These are banks all across the world. Non-bank institutions such as investment banks, insurance companies, and pension funds, mutual funds, hedge funds may invest in other types of relatively riskier securities. They all manage investment portfolio the same. They all are trying to minimize their tax liabilities. At the same time, find a way to stabilize their interest earning ratio. We already talked about assets that consist of investments and loans. We discussed loans management in chapter 7. We talked about investment management in chapter 8. Here we're going to focus more on the tax liability associated with that. We also discussed deposits, which is liabilities, in chapter number 7 as well. There are two major types of securities that all financial institutions invest in. Those that are known as money market instruments and capital market. Money market securities or instruments typically have a maturity of 1 year or less. So they're relatively short term. They're relatively more liquid because they carry relatively lower risk in the event market interest rates were to rise over and above the coupon interest rate on these securities. However, capital market instruments tend to be longer term, more than 1 year, relatively riskier, less liquid, and could generate higher expected return if market interest rates were to fall and lower expected return if market rates were to rise. So the change in the return is significant for long-term securities, which are capital markets, than money market. Obviously, one of the reasons why institutions invest in securities are the following. They want to earn steady interest income, which, by the way, supplements interest income that banks earn on loans, which could not be steady. They try to reduce their credit risk exposure. Securities portfolio relatively tends to be slightly lower risk, particularly for banks, because they invest in government securities relative to the loan portfolio, which could default. They also provide geographic diversification. A bank does not have to be an international bank to invest in international securities. But a bank must be an international bank if they want to give out loans in other countries. It is a source of liquidity which allows them to liquidate the securities in the event they need cash. We will talk about how do they reduce tax exposure when we go through the problem at the end of the chapter. They also provide collateral. This is security against certain types of deposits, particularly for large deposits that are not insured by FDIC. They are hedged against interest rate risk. They provide flexibility, and of course regulators do prefer that banks' balance sheet do have at least 20 to 30% securities portfolio so that they are relatively minimizing the risk compared to having all loans. The diversification of portfolio depends upon the relative institution. Larger institutions tend to have more securities that are more diversified than smaller institutions. What are the examples of money market instruments? They are typically less than 1 year. These are the examples. Long-term securities, more than 1 year term, the maturing over 1 year, are capital market, and they are typically treasuries, local government bonds, we call municipal notes and bonds, and corporate notes and bonds. Please note that banks cannot invest in corporate notes and bonds. However, investment banks and insurance companies, hedge funds, and pension funds can. Banks can invest only in treasuries and municipal. Please review the textbook to get an understanding of what these are. There are also other types of more sophisticated, relatively more risky securities. We call them structured notes, mortgage-backed securities, which are collateralized mortgage obligations, which were the ones that caused the financial crisis. Of course, today we find that these types of securities have been minimized in terms of investment by banks, and so have been more complex securities such as stripped securities. Primarily, banks tend to invest in U.S. government or Federal National Mortgage Association securities, which are securities backed by mortgages, or state and local government securities. And they, of course, have their own common stock and preferred stock. Please note, banks cannot invest in other companies' common and preferred stock. These are their own. To put in perspective, what is the overall portfolio of different securities for banks as of 2010, commercial banks? We find the fact that, relatively speaking, banks have 53.4% of the investment securities are U.S. government, which carry the least risk. And then they have the remaining securities spread out over other types of securities we talked about. However, when you look at the size of the banks, small versus large banks tend to have less government securities and more other types of investments, such as commercial paper and foreign debt securities, such as securities issued by foreign governments. However, if we look at the small and mid-sized banks, their portfolio of commercial paper and international securities is relatively small, but they have a higher percentage invested in U.S. government. This is a very good slide for you, please, to make sure you memorize this. Particularly in the exam, you could be asked a multiple choice question. For example, I could ask, large banks, large commercial banks in 2010 relatively carried what percentage of U.S. government securities? I would give you 4 answers. You should know an approximate. One of the correct answers would be 50 to 55% or 50 to 60%. Okay? I could ask the same question for small and medium-sized banks or overall bank investments. These typically, I will limit my question to U.S. government securities. Please note, you do not need to be concerned about memorizing these. I will not be asking questions on those. Okay? What are some of the factors that determine what types of securities do financial institutions invest in? These are some of the examples. You notice that the second one is tax exposure. Financial institutions try to minimize income tax liabilities. And we will see that in the problem when we're going to look at that problem at the end of the chapter. Of course, anyone will look for returns, risk, default risk, risk associated with the business, how risky does the financial institution want to be. Aggressive banks will invest in relatively risky assets. Conservative banks will invest in more conservative assets. They look at liquidity. How quickly do they want to liquidate? If they want to liquidate the securities in a short term, they will invest in short-term securities. And they look at also other factors as well. Slide number 14 will be excluded. So please do make a note. It's in the syllabus. Obviously, the tax exposure is very important. We'll be looking at this example at the end of the chapter. So for the time being, I'm going to skip this chapter, this particular slide. Please note, these formulas are not required by you. The problem that we're going to solve is mostly doing calculations, not equations. So you are not responsible for the formulas. This is what we'll talk about when we look at the problem. Same thing here. You're not responsible for the formula. Please note the fact that, again, slide number 17 and 18 are not required. So slide 14 is not required. 15 and 16 are required, but not the formulas. 17, 18 are not required. Let's set this aside for the time being until we look at the problem at the end of the chapter to see how we manage tax exposure, income tax exposure. Here we are talking about the different kinds of risks. Now I'm not going to go into detail, mainly because we have talked about this before, particularly in chapter 7. When interest rates rise, longest term bonds suffer the greatest losses compared to short term. Obviously, short term bonds will lose value when interest rates rise, but at a much lower amount than longer term bonds. When interest rates fall, if interest rates were to fall, longest term bonds benefit the most because their profits will rise more than short term. Bond prices and bond values have an inverse relationship to interest rates. They are obviously rated by the agencies, Moody's, Standard & Poor's, and Fitch. The ratings are typically starting with A. A are the best ratings, and those that have the lowest ratings would be C's and D's. What we call A's and B's are investment grade. Those are the best, the highest returns. We are now looking at business risk. If I were to go back just to explain to you what these slides are, I'm going to go back a few slides. These, slide number 13 explains the different factors. Now we are explaining each one of them. Interest rate risk, credit risk, risk of default, business risk in terms of how liquid an institution wants their securities to be. Remember, the short-term securities are more liquid and carry lower risk than long-term securities. A very important thing to remember for exam purposes. Short-term securities are less risky. They earn lower return, but they're less risky because they can be liquidated with the least amount of loss compared to longer-term securities. Call risk is when an investment security has a call provision. Prepayment risk, where the securities has to be prepaid. Inflation, higher the inflation rate, higher the return on the securities. And then there are pledging requirements where those deposits that are not insured by FDIC, those depositors would prefer to have some assets set aside by the bank in the event the bank fails. Banks set aside these securities as collateral, what we call security. And these securities will then belong to the company or the company that is depositing funds that are uninsured by the banks, because they will lose those deposits. In return, they will get these securities. Now, what we're going to talk about the next 4 or 5 slides is that there are different strategies that financial institutions use in managing the securities. These are the 5 different strategies. First, what we call the ladder spaced maturity. What this means that this institution is investing equally 20% of the portfolio equally in 1-year securities, 2, 3, 4, and 5. So those that mature in 1 year and those that mature in 5 years, spreading the risk equally, and that's called spaced maturity. Front-end load means the fact that all 100% of the portfolio is invested in between 0 to 1 to 3 year securities. No securities are invested in longer term. This is the most conservative bank who will invest in short-term securities whose values will fall less if market rates were to rise. Then we have just the opposite. Those aggressive institutions who prefer to invest in longer-term securities, you notice the fact that no securities are invested in short-term. All of the securities are invested in more than 4 years term. Longer-term securities, relatively higher risk in the event market interest rates were to rise. The next one is the barbell strategy. This is a bell-shaped. It starts at 20%, goes up to 30%, remains at 30%, and goes back down to 20. This is a bell-shaped curve. Then finally, we have the rate expectations approach strategy, where based upon interest rates and expectations of interest rate, an institution could spread out their investments, in this example, up to 7 or 8 years. We find that 15% of the securities are invested in year 1 securities, then mature in year 1. Another 7 or 8% are in 2-year maturity, 15% in 3 years, in 4 years we have 7 or 8%, and so forth. So they are spread out, staggering. We will not cover, this slide is excluded. We will not talk about the yield curve. You have studied this before in other chapters, and duration is not covered as well, as we had skipped duration in chapter 7 as well. So the remaining slides are not required. That pretty much covers the discussion of the chapter. What I'd like to do next, please, is to cover problem number 7, which is at the end of the chapter. Again, the problem that we're going to look at, which is assigned, is problem number 7. There are 2 sections to the problem, and we will now go through this. And by the way, I will also post this exact page, the solution, online, so you can have access to this at your own leisure and study it accordingly for exam purposes. However, I wanted to go through this with you today, so at least you can review this recording when you are reviewing this particular problem. Please keep in mind, in the exam, you will have a similar problem assigned to you, or will be asked in the exam as well. I'm going to turn to page number in the textbook where the problem is provided by the author. Page number 352. We have a Lakeway Thrift Savings and Trust Institution, a bank, is interested in doing some investment portfolio shifting. What they plan to do is sell some securities that are on the balance sheet today on the assets and purchase other securities to manage their portfolio, and we call it shifting of the portfolio. Portfolio shifting is one of the key strategies used by all financial institutions to minimize income tax liability. This institution has had a good year thus far with strong loan demand, and it is expecting and they're projecting that revenues and profits will rise this year. So the year has not ended yet. They may be in the fourth quarter of the year, but they already have projected that they're going to have very high revenues compared to previous years. And they expect the revenues to increase 16% over last year. Lakeway is subject to 35% corporate income tax rate. So the tax rate is 35%. The investments officer of the bank has several options in the form of bonds that have been held for some time in the portfolio. What the investment officer is trying to do is sell some bonds and purchase other bonds by shifting the portfolio and try to reduce their income tax liability because they expect high profits. As you well know, if profits rise, income tax will rise. So they're trying to, the bank is trying to incur a loss on sale of securities, and the loss from those revenues selling the securities will offset the higher profits and therefore reduce their income tax liability. That's the key to this particular problem. Now, there are two different scenarios that the investment officer has. A, the bank could sell $4 million bonds that they already have, which are issued by the city of Dallas. They are municipal bonds, local government bonds. The coupon rate on the bonds is 7.5% per year, and the bonds today have remaining 12-year maturity. The market value of the bonds, however, has dropped to $3,750,000. The purchase price for $4 million, the value is now $3,750,000. The reason bond market value has dropped is because interest rates must have risen from 7.5% coupon rate to something higher than that. So market rates have risen, bond prices have fallen. Remember, they have an income tax rate of 35%. Here is the calculation in blue. They will sell the bond, the $4 million bonds, which are currently earning 7.5% interest. By selling these 4 million bonds at 7.5% annual interest, they would forego $300,000 of interest per year, which is 7.5% of 4 million. In return, the bank would like to buy coupon bonds that have a coupon rate of 8%. It says here the fact that the bank would like to buy other bonds which have, and these bonds are issued by Bexar County in Texas. They also have 12-year term, remaining term, but the interest rate on these bonds is 8%. So these are Bexar County bonds. Again, keep in mind that they will take this $4 million and invest in Bexar County bonds, but they will earn 8% interest. Now the bank will actually, the annual interest income will rise from $300,000 to $320,000 by investing in higher interest bonds. They will sell 7.5% bonds. They will forego receiving $300,000 interest. However, they will receive $320,000 interest by buying 8% bonds. The other calculation you need to do, please, is one calculation is this. The second calculation is loss on sale. The book value is $4 million on the Dallas bonds. The market value is $3,750,000. Therefore, there will be a loss of $250,000. The loss of $250,000, the tax rate is 35%, and therefore the bank is going to actually get a tax benefit or a reduction of income tax. They will reduce their income tax by $87,500 by taking the $250,000 loss and offset against higher revenues, which is what they're expecting. By reducing the net profit, overall profit on this $250,000 of loss at 35%, the tax liability will be reduced, therefore it's a tax benefit. However, they will also receive $20,000 higher interest. Okay. The point here is the fact that the bank's objective, their key objective is to reduce their tax liability. That's why they're doing, the investment officer wants to shift the portfolio. So obviously they are able to achieve lower tax of 87.5, and in return they will receive higher interest income of $320,000, of $20,000, $320,000 minus $300. However, please note that any government bonds, particularly issued by state or county, are tax-free. Interest is tax-free. That is typically how Dallas bonds or Baxter County or New York State bonds or Buffalo bonds, any bonds issued by any city, county, or state, the interest is tax-free. Therefore, while the bank will earn $20,000 more interest per year for 12 years, they will pay no income tax on that. They are tax exempt. Interest is tax exempt. They will also receive $87,500 tax credit, which is a benefit from the federal government. So that's one scenario. The second, let's look at the second option. Part B. The investment officer could also do the following. Instead of selling the Dallas bonds, the investment officer could sell $4 million of U.S. Treasury bonds, which have a 12-year maturity. These bonds are earning 12% coupon rate today, which is very, very high and is very good coupon rate. So this is a very high interest rate, high rate bonds, which earns high interest. In return, by the way, when they sell those, it says the fact that the market value on these bonds has gone up to $4,330,000. So in this scenario, the bank will sell the bonds for a higher price because they have a very high interest rate. Rates must have come down and the values of the securities has gone up to $4,330,000. The book value is $4 million, therefore the bank will incur a profit on the sale of $330,000. Because of the fact that the bank will incur a profit, this will create what is known as a tax liability. Profits result in higher tax, income tax. In the previous scenario, we had a loss, if you recall, $87,500. That results in lower tax. Here, it will result in higher income tax. At 35% tax rate on $330,000 profit on sale of securities, the bank will have to pay $115,500 to the federal government in additional taxes. The question is, which of these two options would you recommend if you are the investment officer? Would you rather reduce your tax liability by $87,500 and earn $20,000 higher interest on these bonds tax-free, no income tax on the higher interest? Or would you rather pay $115,500 additionally to the federal government over and above the fact that the bank is going to have high profits this year? Thank you.
Keep going. You're good.
So in this case, if the bank were to sell the $4 million US Treasuries, because interest rates are so high on the bonds, the market rates are very likely lower. That's why the market value is high. If interest rates go down, market value goes up, resulting in a profit. A 35% tax rate will create a tax liability. So the answer to this particular problem is the fact that this investment officer will very likely choose A, because it's going to reduce the tax liability rather than increase the tax liability. At the same time, they will earn $20,000 higher interest tax-free. It is quite foolish for the bank at this point to sell these bonds for two reasons. One is the fact that they are earning very high interest rates. No one wants to sell high interest rate bonds, which, by the way, the interest on these bonds are also partially tax-free. Not fully, but partially. So it's best for them to keep these bonds, because they would have to reinvest this money at a much lower rate, because rates have come down, and also incur higher tax liability. This is not a good option. They would choose A. Now, in the exam, you could be asked questions, please. The question in the exam, a problem that could be asked in the exam, will be as follows. You'll be asked to calculate the tax benefit or the tax liability. You will also be asked to calculate the difference in the interest from selling one bond and buying another bond. And you could be asked to determine what is the overall profits for the bank. So in this example, the bank will not only receive $20,000 this year more interest, but they will also reduce the tax liability by $87,500. So their total profit will be $87,500 lower tax, which is a higher income, plus $20,000 higher interest income, and therefore will be $107,500. $87,500, reducing their expense and increasing their income by $20,000, $107,500. In this scenario, the bank will actually incur $115,500 higher expense. So the answer is A. That pretty much concludes this chapter. Please look out for this solution posted online. I will post this exactly what you see here. All the other solutions from chapter 10 are also posted. They are available to you today. You can look at them now. And please do review the PowerPoint slides carefully, as well as the chapter. Thank you very much.